The average on question 3 was one of the lower averages for the paper. It was only 37% as opposed to an exam average of 49%, and there's a couple of reasons for that. Let's look at the question itself. First of all, this is all the information we have. We don't have a lot of info. So on one hand, that can be easy to read, but on the other hand, it's going to require us to sort of, come up with information and extend our knowledge. We don't have a lot of info that we can refer back to when we answer this question, unless we have a really good understanding and knowledge of accounting theory. So we were asked to consider the statement that information in the financial reports must be both relevant and reliable. However, it may be difficult to achieve both at the same time. Discuss this statement with reference to the depreciation of non-current assets. So what we need to do here is know our accounting theory. So the question has mentioned both relevance and reliability. So we need to know those two qualitative characteristics. But then to get 4 marks here, we're going to need to apply that knowledge to a topic. Now in this case, we're going to apply it to depreciation expense. It could also be applied to a topic such as budgeting, or maybe writing down stock to net realizable value. What's important is that you know the first part, the theory, and then if your knowledge of those two is rock solid, you're going to be able to apply that to many things. So that should help you answer whatever it might be. So what we want to look at is, first of all, what are relevance and reliability? So this is not our answer yet. So with a discuss question, definitions aren't going to get us any marks. We need to have more insight than that. But in formulating our answer, the definitions are very important. So let's have a look. Information is relevant if it influences our decision making by helping us evaluate future decisions or confirm whether past decisions were correct. That's a little bit different to reliability, which says we want information to be reliable, and to do so it must be free from opinions and estimates, must be able to be verified, and we must have a source document to verify it with. Let's look at that in the context of depreciation. What do we know about depreciation? Well, what we know is, let's take an example, a very basic example. We've got a $20,000 delivery van. We think we'll use it for 3 years, and we think when we're done with it, we'll dispose of it for 5. So basically we estimate over 3 years we're going to use $15,000 of this van. So non-current assets are owned beyond one reporting period. We can't write them off as an expense in the period they are bought. What would that look like? Well, if we didn't depreciate things, what would happen with this van is we would charge off all $15,000 of usage as an expense in year 1 in 2015. The problem there is when we do our revenues and expenses to get our profit, we're going to end up with a very low profit in year 1. And then in year 2, we're actually not going to have an expense. We've already allocated all of the usage and economic benefits in the first year. So our actual net profit there will be much too high than it should be. So going forward into year 3, the same thing will happen. So the problem here is that's what happens when we don't depreciate something. So clearly that's wrong. So what we should do, we should use take the usage each period and represent it as an expense. So in this case, we might say $5,000 is used each year. We use the straight line method. We may actually probably use reducing balance for this particular asset. Just for the sake of the example though, we're going to keep it simple here and just use straight line. And then what we do is that enables us to get the most accurate net profit, because we can now accurately match our revenues and expenses. So in this case, we might have revenues of $20,000 in year 1, and that gets us an accurate profit of $15,000. And same in year 2, we get the same, and in year 3. And what we've got there is a more realistic pattern of usage of this van or non-current asset, and we're able to better match it with its revenues over its useful life. And what we're going to end up with, and most importantly, is the most accurate net profit figure. So we need to appreciate things to get the best numbers, the most accurate numbers, but there's a problem. It's all to do with the formula. So if we calculate straight line depreciation, we're going to do cost less residual divided by useful life. If we're going to do reducing balance, which we actually probably would with a delivery van, we'll take the carrying value and we'll times it by the reducing balance percentage. And that's all good. We're going to get accurate, we're going to get the most accurate net profit. But the problem is we've got a lot of guesses here. Residual value, useful life, and that percentage in the reducing balance formula are all guesses. Will the van last 3 years? It might actually last more or less. Will it actually be resold for $5,000 in 3 years? That's unlikely. That's a guess 3 years out. I mean, these guesses there's nothing to say it's going to be correct. If we take a reducing balance percentage of 20, is that going, why is that the correct figure? Could be more, could be less. It's just a percentage that somebody's estimated as the usage pattern, but that may not necessarily be the case. The other thing that we may need to consider is that if we do the straight line method, we're also going to have a cost. Now, that's fine if we buy the vehicle and have a document to prove it, but what if we give it to the business as the owner? Well, we're going to contribute it as at the agreed value, and again, that is another estimate. So what we want to do is formulate an answer. We need 6 points of discussion. So with a discuss question, we need to consider the question from 2 viewpoints. Now, depending on the topic, it could be positives versus negatives, advantages, disadvantages, pros, cons, etc. And we need to have at least one argument in each camp for a total of 6 points. So that could be 5 positives and 1 negative, for example, or 1 positive and 5 negatives, as long as there's an argument on both sides. What we don't want to do is just have definitions on their own here. That's not going to get us any marks. Discuss is much more detailed. So what we are going to do is basically try and answer the question. That's the hardest thing to figure out with this particular question 3. What are we actually being asked to do? Essentially, the question we're answering is, should we depreciate the firm's non-current assets? What do relevance and reliability say? So we need 6 things to talk about. So let's go through some arguments saying we should depreciate things, and let's go through some arguments saying we shouldn't. And in each of these situations, let's use relevance and reliability to back up what we say. So on the first hand, we've got some arguments for we need depreciation to match revenues and expenses for the a non-current asset. Another argument is we need depreciation to fulfill relevance. Why? We're going to make the best decisions if we've got the most accurate net profit. Another argument for is depreciation actually will help us make other decisions, such as when we should replace a non-current asset and also how much to dispose of it for. 4, depreciation must be calculated as it impacts other financial reports, such as the income statement, where it will be an expense, and the balance sheet, because it will reduce the carrying value of an asset. Another argument saying we should depreciate is if we do value a non-current asset at historical cost, so when we do our straight line method, this actually can be verified with a source document, so we will actually have relevance and reliability at the same time. And finally, depreciation will assist in making other decisions, such as when to replace a non-current asset and how much to dispose of it for. What we need though is some arguments against. So I've just gone through 6 arguments for. We need at least 1 against. So let's have a look. We could say we shouldn't use straight line depreciation because there's going to be an estimate of both residual value and useful life. And also if we do contribute the asset to the business, there'll be an estimate of agreed value. Against charging depreciation, if we use the reducing balance method, there's going to be an estimate of that percentage rate. Why is it 20? Why is it 15? Why is it 30? It's just someone's opinion. Some other arguments against are there's absolutely no source documents to verify a lot of these numbers when we calculate depreciation. There's no document to prove residual value. There's no document for useful life, and there's no document for the impact of or the reducing balance percentage. Against, the estimates used in calculating depreciation will most likely be over or under depreciated when the non-current asset is disposed of. We actually have a whole topic where we figure out whether we've made a profit or a loss on disposal. And a profit or a loss on disposal simply comes about because our estimates were wrong. So that's another argument against even charging depreciation in the first place. Looking at how marks were awarded there, we've got 6 marks. We've just given about 10 or 11 points. So clearly we don't need to give too much information. We just want to give 6 distinct, clear points. So as we can see, a lot of students really struggle with that. Discuss questions are always tough. Looking at the top end, only 3% of students could give 6 sort of coherent, cogent arguments about depreciation and its applicability to relevance and reliability. Let's look at the average of 2.2 and see what the examiner said. Students were required to discuss basically 2 topics. 1, do you know anything about depreciation? And then 2, can you relate it to the concepts of relevance and reliability? High scoring responses covered both aspects of this question, so you can't just discuss depreciation without mentioning relevance and reliability, and vice versa. It's very important for this question and any discuss question that you make a link between the 2 topics. So in this case, why was depreciation relevant? Because it's impacting our decisions. And also, why was it not reliable? Because estimates, the figures in it are estimates, and there's absolutely no source documents to back those numbers up.